I'll just start briefly and just say welcome and thank you for being with us this morning for really what is the first in a sort of revitalized series regarding quarterly salons for largely educational purposes. The idea that the Ed Foundation can partner with experts in their field to really help educate folks around topics that are directly related or closely related to philanthropy and to supporting charitable causes and purposes that they hold dear. If you don't know, the Alliant Ed Foundation is essentially the philanthropic partner to Alliant International University and has been doing that work since about 2015. High level, we're really focused on education and mental health. And sort of more specifically, really, we think about our impact in terms of students, graduate students at Alliance International University and the California School of Professional Psychology, along with supporting faculty and staff, and then building bridges to larger community impact. And the way you see that, the way folks feel that charitable impact is really largely through scholarship support for those students, through innovation and seed grants for faculty and staff across the 6-campus system in the state of California largely, and also through the Regional Children's Mental Health Consortium, which is really a fantastic program serving under-resourced children, youth, and their families through practicum of grad students in clinical psychology. So with that said, as I said, this is really the kickoff to our quarterly salon session, and the focus today largely around planned giving in sort of all of its forms, and really designed to be an educational offering to help sort of inform, educate, and inspire alums, donors, and others to think about how to structure giving in a way that really allows for broader impact and legacy giving during one's lifetime and after. With that said, I want to go ahead and introduce Reggie Garcia as our Director of Development and Alumni Relations. And Reggie, kick it over to you.
Thank you so much for the introduction, Valen. Good morning, everybody. As Valen said, my name is Reggie Garcia. I'm the Alliant Educational Foundation's Director of Development and Alumni Relations. We are so thrilled to have you here with us for today's Planned Giving webinar. Whether you're joining us live or catching the recording later, we deeply appreciate your time in learning more about planned and legacy giving. Really, this is an exciting time for us as we're continuously looking for ways to provide more engaging and impactful programming to our community. As you look ahead to 2025, we're committed to bringing you guys even more opportunities to connect, learn, and grow through webinars just like this, as well as other virtual and in-person events. So stay tuned. We have some really amazing things in the works. And be sure to keep an eye out for an email post-event with kind of a feedback survey. We'd love to get your feedback on this. Before we dive in, a couple of quick housekeeping notes. If you have any questions during the presentation, feel free to type them into the chat box. I'll be moderating that, and we'll save those towards the end for our Q&A session. Just as a reminder, today's session is being recorded, so if you miss anything or want to revisit the presentation, we'll be uploading it to our brand new YouTube page, which I will be sharing in our post-event survey. A lot of wonderful things to cover today. Without further ado, I want to go ahead and introduce our first presenter, David Tam. David is a highly respected Edward Jones financial advisor with extensive experience in planned and legacy giving. David has helped many individuals and organizations develop wealth strategies for long-term financial sustainability for over 20 years. David is deeply committed to giving back to his community. He currently serves as commissioner for the San Diego Funds Commission and has held leadership roles with the Mira Mesa Town Council and the Asian Business Association. I'll let him share more about his background and expertise. Welcome, David.
Thanks, Reggie. As Reggie said, I'm a financial advisor here in Kensington, and I've been in San Diego for over 23 years. I've been with Edward Jones since 2003, so 21 years with the same firm. As far as community participation, I'm the chairman of the Funds Commission. I was on the board of the Asian Business Association. I was also a vice president at Mira Mesa Town Council. I'm a patron, circle patron of the Old Globe Theater, donor to the Signet Theater, and also active donor to the San Diego Food Bank. I have a passion for investing. Part of my work that I enjoy the most is helping my clients meet their financial goals so they're able to donate to organizations like Alliant Foundation. It's an opportunity to change lives. To accomplish that, I get to know my clients, and I want to understand what's most important to them. And a lot of times that's philanthropy. One of my clients was telling me in the first part of their career, they learned, the second part of their career, they earned, and then the third part of their career, they return, right? They return back to the community. And I don't do it alone. Part of accomplishing our goals here is having a good team around us. I also want to introduce you to an attorney that we partner with here in San Diego, Stephanie Downer, who helps us with our clients establish trust similar to charitable remainder trust, things like that. So Stephanie, wanted to give you a minute to introduce yourself as well.
Hi, everyone. I'm Stephanie Downer. I'm a trust and estates attorney and shareholder at the law firm of Buchalter here in San Diego. I've been practicing as an attorney for about 17, 18 years now. I have an LLM in taxation, and I'm also a certified specialist in probate, estate planning, and trust law by the State Bar of California. And I really represent families, business owners, professionals, kind of take care of their own personal goals and also their philanthropic goals. And so really, I do a lot of planning that helps people leave a legacy and plan their legacy. And a legacy usually comprises kind of the personal values that someone really wants to pass down to the next generation and to their community. So I do all sorts of planning, including revocable living trust, gifting to irrevocable trust, and charitable planning.
Excellent. Thanks, Stephanie. So our discussion today is going to focus on charitable giving and how it ties into your goals, whether you have a passion to help an organization or you're just starting to think about leaving a legacy. This topic is definitely relevant for you. Whenever I'm meeting with clients or talking with friends, I remind them that you don't have to be wealthy to make a difference in the lives of loved ones or a charity. If you're on a philanthropic journey now, or if you'd like to leave a specific dollar amount to a charity in the future, it's important to create a strategy that helps you control your financial legacy. So with that in mind, today we'll talk about all things charitable giving. We'll start off with giving and taxes and considerations for giving strategically. And finally, we'll explore advanced giving strategies. Before we begin, I do want to remind you that I personally cannot give tax or legal advice. I encourage you to talk to your tax professional and estate attorney like Stephanie about your individual situation. Also, at the end of this presentation, I can email you all our charitable giving strategy reports that provides more details and gives references for what we'll cover today. So there's a lot of information packed into this presentation. I want you to feel free to ask questions along the way. Reggie's going to handle those in the chat box. This is informal, interactive, so please don't hesitate to jump in with questions, Reggie. I'd like to start our discussion with a couple of statistics. They surprise me. In the past few years and after the pandemic, charitable giving has actually gone up. So let me show you that. Total giving in the US reached $499 billion in 2022, $500 billion. That's outstanding. And also annual giving has increased by 16.7% since the start of the pandemic in 2019. So really good numbers. These show that even during and after the pandemic, Americans want to help their loved ones and communities. We're going to go over taxes here. So since you're here today, you're probably interested in giving back and leaving a legacy. There's so many ways to support a cause like Alliant that's important to my clients and to you. You might donate time by volunteering. You might give items to a charity, or you might contribute money. How you give is a deeply personal choice. Today, we're going to focus on giving financially. And for the next couple of minutes, I'll talk about potential tax benefits and trade-offs. The next slide here goes over, in addition to supporting an organization, one of the benefits is a tax deduction. So if you choose to itemize your deduction, the amount of charitable deduction depends on, number one, your gross income. Number two, the type of asset you donate and how long you've owned it. Number three, the type of organization that you support. To claim a tax deduction, the donation must be made to a qualified organization in good standing with the IRS. When claiming a tax deduction, the donor can't receive a personal benefit from the gift. For example, you can't get, let's say, Super Bowl tickets or a table in exchange for your donations. Any personal benefit you do receive will reduce the amount of your tax deduction. So if you gave $1,000 to your favorite college and received, let's say, season tickets that are valued at $700, your charitable deduction would be worth $300. The next slide goes over deduction limits. There's 3 factors here. Number 1, AGI, adjusted gross income. They're typically calculated as a percentage of AGI. This represents the maximum amount that you can deduct each year. The second thing is what you're donating. So the type of asset. Examples are IRA assets, retirement accounts, cash, appreciated property, ordinary income property. Number 3, the type of charitable organization. Direct gifts to public charities and donor advised funds generally have a higher AGI limit than gifts to private foundations. Gifts from an individual to another individual to help pay for unexpected expenses. I get this question a lot. If I give my child a college tuition, can I deduct that? No, unfortunately, those are not tax deductible. And if it's above a certain amount, you might be subject to gift taxes. The next slide here goes over integrating into your existing strategy. So let's touch on how to integrate giving into your financial plan. Number 1, carry forward. You can carry forward any unused portion of the tax deduction to offset future income for up to 5 years. So let's say someone that makes $100,000 gave $75,000 in cash to a charity, limiting their deduction to 60% of their AGI. So you can carry that forward for 5 years. Multi-year planning. Work with your tax professional on potential tax planning. Depending on your unique circumstances, it might be more advantageous to aggregate donations into a single year, or it could be better to split donations into multiple years. Let's say you're selling a piece of property and you have a large capital gain that you're trying to offset. It's a good idea to try to stack that donation in a year that you're realizing that gain. Number 3, record keeping. If you plan on itemizing your deductions, the IRS requires that you substantiate your donation. For amounts under $250, your own records like a canceled check can suffice. For donations of $250 or more, you have to get written acknowledgement of the donation from the charity. It's a charitable donation receipt. All qualified charities should be able to provide you with this type of documentation. Number 4, estate taxes. Individuals and couples with taxable estates might benefit from charitable giving. A lot of people opt to leave money to a charity at their death. This provides control of your money during your lifetime should you need it, and it can help minimize estate taxes. Conversely, by donating assets during your lifetime, you remove these assets from your estate, which can also lower the estate tax liability for your heirs, and you may get a current income tax deduction. That said, the trade-off is that you no longer have access to that money if you need it. Number 5 is legislative risk. Keep in mind tax deduction limits and tax rates are subject to legislative change. Timely topic. We just had a big change in Congress, Senate, and the White House. While it can be beneficial to have a long-term plan for your charitable giving, you might need to revise the plan as tax laws change. Number 6, balancing your goals. It's important to understand the impact your giving goal might have on your other financial goals. Think about the trade-offs you are and are not willing to make to achieve them, like delaying retirement or living on a little less income. And the next slide here goes over structuring your strategy. So when it comes to charitable giving, how and when you give matters just as much as what you give. So be strategic in choosing which assets to give. How to structure your giving goals can be beneficial for both you and your charity. In the next few slides, we're going to cover giving your lifetime, giving during your lifetime, and also giving at your passing. So lifetime giving. A lot of people choose to make charitable donations during their lifetimes because they see the impact of their gifts, and it entitles them to an immediate tax deduction. Potential downside is that you must irrevocably part with the money, so it can no longer be used for your other financial needs. There's 3 ways to do this. Number 1 is the most common. You give through periodic outright donations during your lifetime. You can do this through cash. Recently, I had a client donate their Qualcomm stock that had highly appreciated, or you can donate physical property like real estate directly to charity. While it's often the most convenient and expedient means of giving, it may not be the most tax efficient way to give, and the donor retains no beneficial interest in or control of the assets. Number 2 is stacking your giving. If you have a multi-year giving plan, but don't expect to be over the standard deduction, consider stacking several years of giving into a single year. By doing this, you might be able to realize greater tax savings by itemizing this year and then taking the standard deduction in subsequent years. Number 3, donor advised funds and other charitable channels. At my firm, Edward Jones, we have a charitable gift fund. It's an donor advised fund. It gives you the potential for an immediate tax deduction for your irrevocable donation into this fund. In addition, you'll have opportunity to advise on how the money is invested, when the funds are granted, and which charities receive your grants. Since the money's invested, you do have potential to grow your charitable impact over time. So if you're looking for more control over how your charitable dollars are invested and when the funds are dispersed to charity, you have choices. So lifetime giving, what to give. So cash, let's talk about cash. When you give cash directly to organizations, it's easy. It's the most common way to do it. You're allowed to deduct the full amount of the gift up to 60% of your adjusted gross income. And you're allowed to donate 30% to private foundations. So 60% of your AGI to public charities. You can only deduct 30% of your AGI to private foundations. Cash is easy to give, but it might not give you the most tax benefits. Number 2, appreciated securities. Giving long-term appreciated securities such as stock, you get a double tax benefit. First, you're entitled to an income tax deduction for the full market value of the securities on the date of transfer. So you're allowed to deduct up to 30% of your AGI for gifts to public charities, or 20% of your AGI to private foundations. Second, neither you nor the receiving charity recognizes and pays any capital gains on the transfer. So this means the charity gets more money and you get a higher deduction. Number 3, QCDs, IRAs, donating assets given directly from traditional or Roth IRAs to a qualified charitable organization, or in some cases to a charitable trust. That's called a qualified charitable distribution. That's an option if you're over the age of 73 at the time of distribution, or 70 and a half if you've already started. A QCD does not increase your AGI, and it can satisfy your required minimum distribution. For folks that are taking required minimum distribution, this is very attractive. A lower AGI can result in a lower tax bill. You can exclude up to $105,000 of QCDs from your taxable income per year. QCDs are available regardless of whether or not you itemize. Other assets, real estate, collectibles, businesses, you might be able to donate real estate, businesses, and collectibles. These rules and considerations around donating these types of assets can be more complex, and they may require independent appraisals and specialized tax services. So I've covered the choices of what to give. There's a lot more beneath the surface. So you definitely want to talk to your advisors to explore all the details. The next is giving at your passing. So how do we give? We're going to talk about giving to charity at death. That allows you to maintain control of the assets during your lifetime should you need them. Your estate is eligible for an unlimited charitable tax deduction. So giving can reduce your heirs' estate tax liability. Number one, a will. A will can provide the opportunity to give instructions on how you want your assets to be distributed. Stephanie, why don't I have you jump in here and chat a little bit about the differences between wills, TODs, PODs? Is that something
Yeah, that's great. That's
Perfect.
great. Thanks, David. So yeah, this is going to be something that you're really going to want to think about for your personal estate plan for giving at your passing. Wills, so just kind of the difference between wills and trusts. Hopefully we have a lot of donors with trusts, but wills and trusts are basically testamentary documents. Wills govern assets titled in an individual's name at the time of their passing, and a trust governs assets titled in the name of the trust at an individual's passing, okay? And so these are ways in which you can make either specific bequests, like of a certain dollar amount or a percentage of your estate to a charity at your of kind of like the total amount of your estate at your passing. Whereas a beneficiary designation would be something like, as David was mentioning, if you wanted to leave your, for instance, IRA or a portion of an IRA or qualified account to a charity, you can always designate them as a percentage beneficiary under a validly executed beneficiary designation. IRAs are always great if you are charitably inclined and you are thinking that you want to have use of that asset during life, but at death, you really want to have a philanthropic goal. IRAs are great assets to be able to pass on to charities because charities do not recognize the income tax that your individual beneficiaries would as they pull out the money from those IRAs as a beneficiary. Okay, so that's something that I counsel with my clients a lot of that are very retirement heavy in terms of their assets is kind of, do you have a philanthropic goal and would a charity be a possible beneficiary of retirement accounts? Transfer on death and pay on death designations are similar to beneficiary designations, but those govern individual accounts like checking accounts, cash accounts, or for instance, marketable securities accounts held in your individual name. You can designate beneficiaries of those accounts by filling out a transfer on death or a pay on death beneficiary at the time of your passing. And so that would be something where once you pass and a death certificate is submitted to the institution, that beneficiary immediately vests in whatever is left in that account, and the account would be paid over to either charity or individuals. And structured charitable channels, that's going to be more of a embedded charitable plan within your estate plan. Okay, and so this is going to be something that we really want to make sure integrates with, for instance, your non-charitable goals and finding ways that we can give to charities at passing. I do think that donor advised funds are really the most in vogue charitable channels that I'm starting to see with a lot of my clients. It allows for, quite honestly, not only lifetime gifting, but gifting at your passing. And then it also gives the donor some controls on the kinds of charities they want to pass assets on. So for instance, as David was mentioning, for donor advised funds, they are funds held at a financial institution that are treated like 501c3 charities. So you can give certain assets to donor advised funds and then designate which charities, once the assets hit the fund, you get to designate the annual distribution to 501c3 charities from within that fund. This is a great option for people who have multiple charities that they want to give to. It also is a great option for people who are trying to pass on a legacy of charitable giving to their family and help families start making decisions on the kinds of charities and involvement on the kinds of distributions and charities that are benefited from a particular family.
Perfect. Stephanie, I'll take this one. So
Yep.
what to give? Cash can be transferred directly to charity of your choice at death and eligible for unlimited charitable deductions for your estate. In some instances, estates do need cash and other liquid assets to settle debts or cover expenses. So it's advisable to make sure your estate has enough liquidity to cover those expenses. Appreciated securities, we talked about that earlier. They're eligible for a step up in cost basis when you leave it to an heir. That means the securities revalued for tax purposes at your death. This new value become your heir's basis from which any gain is calculated, and it wipes away your taxable capital gains. So if you wish to transfer wealth to heirs and charity, appreciated securities may be more beneficial to your heirs when compared to other assets. So it may be less advisable to leave them to charity at passing. IRAs, depending on the type of IRAs that you have, it might be more or less beneficial to pass to charity, and depends on whether you wish to leave money to non-charitable heirs as well as your relationship with heirs. Life insurance, if you want to leave a specific dollar amount to charity, funding a life insurance policy might be a good option. You can name a charity like Alliant as a beneficiary. So the life insurance policies do allow for multiple beneficiaries. You can split proceeds among multiple charities and also non-charitable beneficiaries. If properly structured, proceeds from life insurance are not subject to estate taxes. You could also consider giving assets to charity during your lifetime and naming your heirs as the beneficiaries of a life insurance policy. This allows you to get an immediate tax deduction, see the benefit of your donations during your lifetime, and also give your heirs tax-free proceeds. Other assets like real estate, businesses, and collectibles have complex considerations. Decisions on how to handle these complex assets can be made with the guidance of your attorney and your tax advisors. So next, we're going to go over advanced gifting strategies. Stephanie, I'm going to bring you back in here. If you desire control and flexibility or have unique needs, we're going to go over charitable remainder trust, charitable lead trust, charitable gift annuities, pooled income funds, and foundations. So first, I'll have Stephanie cover charitable remainder trusts.
Okay, thank you. So charitable remainder trusts are certainly something that I deal with a lot with clients who have appreciated assets during their lifetime. Okay, so at a charitable remainder trust, what that is it's a split interest trust. What a split interest trust means is that you are giving an asset to a trust and retaining an interest, but also giving an interest away. Okay, so there's kind of the split interest is that you're keeping something either for a term of years or your lifetime, but you're also saying that at the end of the term of years or my lifetime, a charity is going to get this asset, whatever the remainder of the asset is. These kinds of structures are really great for people who have charitable intent. First of all, you really have to have charitable intent, but also that are looking to defer a capital gain recognition event over a series of years or their lifetime. And so here's kind of how these assets work. Let's say, for instance, I am counseling with David's client who has very highly appreciated Qualcomm stock. Okay, we know that if he were to sell Qualcomm stock individually, you recognize capital gain between what you pay for the asset versus what you sell it for. So the difference between your basis, what you pay for it, and what you sell for it, you're going to have to pay a capital gains tax. And capital gains taxes are at the highest rate federally, 20%, and then here in California at the highest rate about 13.3%. There are certain assets that when you sell them, they're also subject to a NIT tax of an additional 3.13%, but I think for purposes, if you're a California resident, capital gains at the highest rate could likely be around a third. Okay, so it's like kind of what you think about. So when you donate an appreciated asset to a charitable remainder trust, let's say we're donating this Qualcomm stock, you get an immediate income tax deduction for the value of the asset going into the trust as to what the IRS believes that the charity will get at the end of the day. Okay, so the way that a CRT works is that you put an asset into a trust and you retain some sort of income stream. It's either a fixed annuity amount like 20,000 a year, 50,000 a year, or you receive a percentage of the value of whatever that asset is sitting in the trust. So for instance, if we put a $1 million asset in that trust and we retain maybe 7%, a 7% interest, we're getting 7% of $1 million, so about $70,000 a year back, okay? So when the income tax deduction of when you put an asset into the trust is basically the IRS splits, we think that you're going to receive a certain amount during your lifetime of that $1 million. And we think that a charity will likely get a certain amount at your passing. The remainder amount that's going to charity at your passing is your income tax deduction. Okay. Right now, the way that the IRS calculates, these values is based on something called the 75/20 rate, which is an interest rate that's published by the IRS. That's what the IRS thinks that what assets will grow to over your lifetime. Okay. The higher the interest rates are, the better a CRT is for the donor in terms of the income tax deduction and also the amount that they're going to be able to pull out of the trust. Okay. So usually when we're looking at high interest rate, low interest rate environment, CRTs actually work a little bit better in a high interest rate environment. So that's going to be something for income tax deduction. Now, charitable remainder trusts really kind of serve a lot of purposes, but they really help for someone who wants an immediate income tax deduction, donation of an asset to a trust, but also wants to keep an income stream either for the rest of their life, the rest of them and their spouse's life, or for a term of years, up to 20 years, okay? So you're able to kind of take these streams during your lifetime, and then when you pass away, the asset goes to charity. The capital gain component of this plan is always also a really important component. So not only do you get an income tax deduction for a portion of the asset you transfer to the trust. When an asset is sold by a charitable trust, there is no immediate recognition of capital gain taxes. So if you were to have sold that asset in your own name and recognized income tax and donated the proceeds to charity, you would still have to pay that capital gain tax, where if you donate the appreciated asset to the trust, the capital gain tax gets deferred. As you pull money out, the income that you're receiving out, okay, these trusts have very particular rules where they basically say, look, if that $1 million generates some income, first of all, if you're receiving 70,000 a year, you're going to have to recognize income tax to the extent the trust earned income. So let's say the trust earned 30 grand of income, but you're pulling out 70,000 that year. The first 30 grand you pull out is going to be income taxable to you. The remaining portion that gets pulled out, the trust remembers that there was no capital gains tax paid when that Qualcomm stock was sold by the trust. It remembers the capital gain inside of the trust. So to the extent you pull out more than the net income in any year, you're going to be pulling out assets at a capital gain rate. So if the first 30,000 of your 70,000 was income taxable, the remaining 40,000, let's say, would be capital gains taxable to you. So these structures, while they provide an income tax deduction, there is a capital gain deferral component as well. So that's really kind of what CRTs are looked at. A lot of people use marketable securities for CRTs, business interests for CRTs, and real estate for CRTs, but there are very specific rules on when you get tax deductions with these kind of hard to value assets. It's a little bit easier with marketable securities because the value is immediate. You could log on to any kind of trading website and find out the value of your marketable security. Real estate business interests require appraisals, and they have very specific rules on the sale of those assets. So you'll want to talk to an attorney if you're going to donate those kinds of assets to these trusts. But the benefit of charitable remainders trust is really it allows the donor to receive a lifetime income stream that's somewhat controllable at the onset. And then, you just have to see sometimes the income is insufficient for future needs. You've given the asset away, and so you have already gotten a charitable deduction for that remainder. You can't collapse the trust and take the assets back. You're kind of stuck with the income stream that you signed off on when you started the trust. So that's going to be something. Another thing is that these structures are, there's going to be a price tag to set it up. There might be appraisal costs. You might have to pay an attorney like me to draft the trust, to do the analysis. There's also a very specific tax return that needs to be filed every year. Normally the CRT can pay for those tax returns itself, but it's just going to be an out-of-pocket cost. So when you look at these kind of structures, you just really want to make sure the juice is worth the squeeze of what you're going to have to go through, and that the benefit that you're going to get is really kind of worth it in the end. So, charitable remainder trusts, though, are honestly the most popular charitable split interest structure that I deal with and that I counsel with clients. Another structure out there is a charitable lead trust. Charitable lead trusts are almost the inverse of a charitable remainder trust. It's a split interest trust where you're going to benefit charity during your lifetime. So it's almost like I'm going to benefit, and the payments of the trust are going to go to charity for a term of years. Let's say it's a 10-year CLT. It pays an annuity amount or a percentage to the charity for that 10 years. And at the end of the 10 years, whatever is left in the trust goes either back to you or to your children or other beneficiaries that you have. So this again is a play with interest rates and the way that the IRS calculates. So this kind of structure, what you're trying to do is that you're trying to ensure that the payments made to charity, you donate an asset to the trust, you get an immediate income tax well, actually, there are a couple of different ways to structure CLTs, grantor or non-grantor CLTs. So the income tax structure can either be upon onset or as the payments are made every year. So you have a choice with that. But this is a home run for charities and an estate plan if the growth of the trust assets exceeds or is equal to the value that's being paid to charity every year, because it's one of those things where you get that deduction to charity for a term of years as the payments are being made out. But after the term of years, what's ever left in that trust goes to your family or to your children or to a trust for the benefit of your children. So if you can kind of make sure that the trust keeps growing despite these payments, you'll have a big chunk of money at the end of the day to go to kids. These kinds of trusts, as being the inverse of CRTs, work really well in a low interest rate environment. So charitable lead trusts, I see a lot during lifetime, but I also see these kinds of trusts embedded in people's estate plans who are looking to zero out estate taxes after they pass away. So there are a lot of, you can set these up during lifetime or at death within your own family trust. So there are options for charitable lead trusts. And so, every single trust has pluses and minuses to them, and their charitable lead trusts, honestly, during lifetime have a lot of ticklish income reporting requirements. Okay, so you certainly want to counsel with an attorney on with these trusts, because whether you have to declare the income on behalf of the trust and get that corresponding charitable deduction can really make a difference as to whether these really provide the benefit and value during your lifetime, or whether they would be more suitable as a structure that are created by your trust after you pass away.
And I can take the charitable gift annuity. So a charitable gift annuity is something where you get a partial tax deduction and a fixed income stream. You get guaranteed payments for life for you and up to one additional beneficiary, usually your spouse. in exchange for an irrevocable gift to the charity. This is charity specific. This is not something that I see too often. The income payments are taxable to the income beneficiary, and it depends on the type of assets that you contribute. How it works is that you make a donation into the charitable gift annuity, you get a partial income tax deduction, and then the donor gets a fixed lifetime income. The remainder goes to charity after you both pass away. So the benefit, you get fixed payments, you get some tax deduction, the proceeds benefit, and are managed by your chosen charity. Trade-offs, your gift to charity, to charitable gift annuities will only benefit one charity. So if you want to support multiple charities, you need to set up multiple CGAs or consider another giving strategy. Annuity rates and income payments will be lower than with a non-charitable annuity since it is going to charity. And then also the annuity payments are fixed, so they might not keep up with inflation. The next one here is pooled income funds. What is it? They're administered by a specific charity. They allow for irrevocable gifts to the fund in exchange for an income tax deduction and lifetime income for named beneficiaries. So if you take a look here, donor puts assets into the pooled income fund, you get a tax deduction. One or more beneficiaries get income for a specified period during their lifetimes, and the remaining amount goes to charity after the income period. So what are the benefits? Because they're administered by charities, pooled income funds are less expensive for the donor than a CRT. The trade-off is that the donor gives up control and flexibility compared to a CRT. The income payments, if the income payments are greater than returns, future payments can be reduced. Stephanie, are you okay taking over the foundation portion?
So private foundations are really tax exempt entities. They're highly regulated by the IRS, but they can provide families the option to really do very customized charitable work. So really a foundation is a legal entity that a family would set up and that you would be able to control for your particular charitable purpose. Okay. This is something that gets funded from the person who sets up the foundation. So this isn't necessarily something that would rely on public donations to run itself. So we think of like the big foundations we know, the Bill and Melinda Gates Foundation, or the different large foundations that are set up by very ultra wealthy or high net worth families. This is its own legal entity. It allows for it to exist for as long as someone is running the foundation and for as long as its charitable purposes is being fulfilled. So these are things that really allow families to customize their charitable giving strategies for a very particular purpose that maybe isn't covered by public charities or cannot be done by public charities. Again, they have a lot of reporting requirements and they're highly scrutinized. So these are going to be things that you want to take some time and just know that they are probably going to be on have a little bit more cost output to set up. But the benefits are that they really allow control. They allow control on how the money is invested, how it is granted, and the kinds of grants that you can give can be, for instance, for international charities, whereas a lot of times like income tax deductions to charities are limited to 501c3s that are based in the US or at least have a US holding company. So foundations allow a little bit more flexibility of the kind of charitable grants you can give, and the charitable purposes are a little bit more global, and they allow for you to really customize your philanthropic legacy. However, there are a lot of trade-offs to foundations. The amount of deduction, the deduction limits are much lower with foundations, usually 30%, sometimes 20% of AGI. And so there's a lot more of a carry forward to realize the charitable deduction benefit for giving to foundations. Again, your contributions are irrevocable and they really require a large amount of funding. I really don't suggest setting up foundations for any less than $1 million. Quite honestly, I'd probably bump that up to about 3 to 5 million is really what you want for it to make a foundation be successful, just because of the large output to set up a foundation, and then the run cost of a foundation, the annual carry cost of the foundation every year. And so I think that foundations certainly have a time and place. The difference between foundations, where foundations were very big, I would say probably about 20 years ago, before they really became highly scrutinized by the IRS and have a lot of kind of onerous reporting requirements. The offset to a foundation are really donor advised funds that give you a little bit more of that flexibility to benefit a lot of different causes, not just one cause, but a lot of different causes, but give you the ability to kind of control how the money is invested, and what you're given every year. You're just, donor advised funds are limited to 501c3 charities, but they get that true 501c3 charity 60% AGI deduction limit. There's a little bit more flexibility with that.
Yeah, I think foundations, have more flexibility. Let's say you're doing international giving for disaster relief. You get a little bit more flexibility there.
Yep, exactly.
All right, we covered a lot of info today. We covered giving and taxes, giving strategically, and we went over all the different strategies. I wanted to take some time now. Reggie, do we have any questions?
Yes, we do. And before I dive into them, I want to thank both you, David and Stephanie. Wonderful presentation. Really, you covered so much incredible stuff. I'm sad we only have an hour to cover it, but really, thank you both so much for this. I do have some questions, and I'll go ahead and read them out from chat. So one of the first ones that we had, I make my gift from my IRA, which enables me to not pay taxes on the distribution. Does this also apply to 401ks?
That's a great question. Typically, what I recommend is making that 401k and turning it into an IRA, because 401ks are tied to employers. So they have control over the asset choices in your 401k. I typically see maybe 10 to 20 different investment options. If you roll it into a self-directed IRA, you have the power. You're now able to choose from tens of thousands of investment options. 401ks are great, but if you're not with your former company, your money should not be either, because if they go out of business, that can create some issues getting that money over to you. But to answer the original question, if you're taking an RMD from a 401k, there are ways to turn it into a QCD, but it's way easier to just put it into your self-directed IRA so you have the power.
Perfect. Next question we had, could we use a trust that manages the relationships with the MPOs/foundations to ensure it's always doing with your money what you desire?
Stephanie, this is more of a you question.
Yeah, and so this is going to be something, so MPOs, not quite sure what that stands for, but I think that
Nonprofit, is that what you were saying?
Oh,
Yeah.
nonprofit NPOs. I'm sorry. Okay. So nonprofit organizations. So the trust, somewhat. Okay, so with CRTs, for instance, a lot of times we have donors that keep the charitable beneficiary revocable, so that you get to decide where the charitable beneficiary goes. With CLTs, I believe you have to lock in that charity for the most part. But at the end of the day, I think that that is going to be something that is really important. I think that, that is one of the benefits of DAFs, where if you're making a large contribution, you need a large charitable contribution, you don't have to immediately turn around the entire fund of the DAF to a 501c3 charity. It's kind of in this fund and it just has grant making ability on an annual basis. So it allows you to test run charities and kind of see how your donation is being used. But unless you're like within a charity itself and on its board, it's very very hard to control the ways in which they use their money. Now, you can always give when you give to charities for a very specific purpose. I see that a lot in estate planning, where it's like, I want to give to Alliant University, but for this particular use, for Alliant University to use it. And that's going to come down to, can Alliant actually do the purpose, fulfill the purpose for which the donor is trying to use it. And so there's always a very open conversation that I very much suggest, if you're going to be a long-term donor to a charity, to talk to charities about the kind of assets that you want to donate and the kind of uses that you can give to the or that the charity can use the funds for in the long term. Because a lot of times, like I see this a lot with uses of funds, but also particular assets, specifically in the tangible personal property arena. A lot of people will have these very high value personal, like tangibles, maybe art, collectibles, things like that, and they want to donate it to a charity or a museum or for some specific purpose. And sometimes charities, while they really love your donative intent, can't use a violin from the 1700s to fulfill a charitable purpose. And so there has to be a conversation with the charity, because honestly, it really affects your charitable deductions on, like, if you're going to give appreciated property to a charity, how can they use it to fulfill a charitable purpose, or if they're just going to sell it. And depending on the kind of asset you give, that really affects the kind of tax deduction you can take. But I think at the end of the day, it really fosters this open conversations with charities on what are the kind of purposes that I can specify the use of this money for, and then have a long-term relationship with them where you can kind of grow and, like, year after year, see how they use their money, and therefore more clearly refine the charitable use of that money moving forward.
Perfect, perfect. I did hear you mention DAFs. Quick question within that. Are DAFs irrevocable?
The gift to a DAFT is irrevocable. So the gift is irrevocable, but the charities that you benefit within the DAF can be updated year after year. So the grants that you're giving to charities can be updated. So say you give $1 million to a DAF, that gift of $1 million is gone. But you have control over how that money is invested, kind of like what it's used for, and then the annual grants of how much of that $1 million goes out to charity every year. And that's what really helps bring family members in, at least from an estate planning perspective. If philanthropic giving is really a legacy point in your personal life and what you want to leave for your kids and grandkids, I think that this is very helpful. It's a great kind of tool to use for that purpose.
Perfect, perfect. Before I launch this one, do we have time for one more question by chance?
Sure.
Fantastic. And on this topic of DAF, is there a specific initial donation threshold to open a DAF? And what time frame do you have for giving these dollars away?
So that's the great news about DAFs is there is no specific time frame. You can keep that money in there until you pass away. As long as you're designating charities as the beneficiary to the DAF, you're good to go. But what I normally see is I recently had a client sell a business, right? Sold it for, I think, $6 million. A lot of that was gain. So they wanted to sock away a lot of money to their charitable intent. So they normally gave to their church a set amount every year. So instead of just taking those donations over years and years, he put all the money into a DAF for the next 20 years that he would have donated to that church anyway. So we put in $250,000 into that DAF. As far as an initial amount, $25,000. But the benefit to doing the DAF is you recognize that entire amount you put into the DAF, and then you can split up those donations over time. You are in control of which charity you give to, how much you donate, and there is no specific time frame that you have to be controlled by.
Perfect, perfect. Thank you all for that.
All right. Anything else?
Let's see. We had one more question, and it was just to ask if it was possible, and I know we have a little bit of time left, if we can go over QCDs in just a bit more detail, maybe just a high-level overview of QCDs.
Sure. So the IRS requires that once you turn 73, that you have to take a minimum distribution from your retirement plans. So an IRA, 401k, the pre-tax ones. So Roth, no required distributions. So a QCD allows you to fulfill that required minimum distribution. We'll call it RMD for short. So let's say you're required to take out 100,000 a year from your IRA, but you don't need it, right? And you don't want to get taxed on it. You could theoretically make that $100,000 distribution a donation. So QCD, now that 100,000 goes directly to Alliant Foundation, right? So now you are benefiting the charity and you're fulfilling the RMD and you have no taxes on it, because the RMD, typically you get taxed at ordinary income. The average ordinary income rate in this country is 22%. Plus, what's the state tax on that? 9.4. So that 100,000, if you were to take that RMD, you're paying a third of it to the government, right? So instead of paying the IRS, why not give the distribution to your favorite cause? And none of it goes to the government. So that's why a QCD is beneficial.
And David, just to clarify, in those cases, the funding has to be distributed directly from the bank, if you will. It doesn't, you never take the personal distribution and then donate it.
So at Edward Jones, you just let us know when it's RMD time. That's typically now. November, December is when we see the bulk of RMDs go out. And you just let us know contact info, the tax ID number of your charity, and the address that I'm sending the check. And that'll fulfill your RMD. It has to come directly from your financial institution, such as Edward Jones.
Perfect.
All right. Perfect. And I think that's pretty much it for what we got in the chat. Again, I want to thank both David and Stephanie. Wonderful insights today. I can't thank you enough for your time today. Really excited to share this with the rest of our constituents. And I'll hand off to Val for closing remarks.
Time very well spent, folks. This is a great presentation, great overview, some good depth on a couple of these more complicated systems as well that I do think can open up sort of the initial vetting for a donor to say, what makes the most sense for me? What I think is also great is that we have the ability to refer and to rely on you for some of the more kind of detailed questions or nuances that may come up. And would love to be able to do that as we distribute this and questions come in. We'd love to obviously stay in touch. And for those folks that really have questions that, as David said early on, there's some things that the charity can't answer and shouldn't answer in terms of tax advice. So we really, those partnerships to be able to go to where that expertise lies and to be able to then help donors get the education they need to make the best informed decision is incredibly valuable. Thank you for being a part of that journey today. We truly appreciate it and look forward to staying in touch.